If you are over 60 years old, the economy you are retiring into may be very different from the economy you spent most of your life working in. That may sound dramatic, but look around. Prices are changing, technology is changing, housing is changing, healthcare costs are changing, retirement is changing, and perhaps most importantly, the rules that many people relied on for decades are changing. For most of your working life, the future probably felt relatively predictable. You worked, you saved, you contributed to a pension, you planned for retirement. And while there were certainly economic ups and downs, many people believed they had a reasonable understanding of what the future would look like. Today, that certainty is fading. And that is why understanding the economic changes happening right now may be more important for seniors than ever before. Because when you are 25 years old, a financial mistake can often be corrected with time. When you are 65, 70, or older, time becomes a much more limited resource. That is not meant to create fear. It is meant to highlight reality. The decisions made during retirement often have consequences that last for the rest of a person's life. And the world is changing faster than many people expected. The first economic change every senior should watch is inflation. Inflation sounds like an economic term used by politicians and central bankers, but in reality, inflation affects nearly every decision retirees make. Inflation simply means that prices rise over time. The same groceries cost more, the same electricity costs more, the same insurance costs more, the same medical services cost more, the same life costs more. For people still working, inflation is difficult. But for retirees living on fixed incomes, inflation can be especially dangerous. Imagine filling a bucket with water before starting a long journey. That bucket represents your retirement savings. Now imagine there is a small leak in the bucket. At first, you barely notice it, but year after year, the water level slowly falls. That is what inflation does to purchasing power. Purchasing power simply means what your money can actually buy. A retirement account may still show the same number of dollars, but if everything around you becomes more expensive, the value of that money slowly declines. This is why inflation remains one of the most important economic forces seniors should monitor. The second major change is housing. For decades, homeownership was often considered the foundation of retirement security. Many retirees entered retirement with a paid-off home. That reduced monthly expenses and created stability. But housing is changing. Property taxes are increasing in many areas. Maintenance costs continue to rise. Insurance premiums are becoming more expensive. Utility costs are rising. And for retirees who rent, housing pressure can be even greater. Many seniors are discovering that housing costs no longer stop after the mortgage is paid off. In some cases, housing is becoming one of the largest retirement expenses. And because housing affects every part of daily life, this trend deserves close attention. The third change is healthcare. People are living longer than previous generations. That is wonderful news. But longer life often comes with higher medical costs, more prescriptions, more treatments, more specialist visits, more long-term care needs. Healthcare inflation often grows faster than general inflation. In simple terms, medical costs can rise faster than many other everyday expenses. This creates a challenge. Retirement may last 20, 25, or even 30 years. The longer retirement lasts, the more important healthcare planning becomes. A comfortable retirement can change very quickly if major medical expenses appear unexpectedly. The fourth economic change is debt. Many people assume debt is mostly a problem for younger generations, but that is no longer true. Today, many seniors carry mortgages, credit card balances, vehicle loans, or other financial obligations well into retirement. Debt is not automatically bad. The problem is that debt requires income, and retirement often means income becomes more limited and less flexible. A monthly payment that felt manageable while working can become stressful after retirement. That is why debt deserves careful attention during periods of economic uncertainty. The fifth change is technology. Many seniors did not expect technology to become a major retirement issue. Yet today, technology affects banking, healthcare, shopping, communication, government services, and investing. Artificial intelligence is accelerating these changes even further. AI is helping companies reduce costs, automate services, and change how information is delivered. For some retirees, this creates opportunities. Services become more efficient, information becomes easier to access, but for others, technology can feel overwhelming. Scams are becoming more sophisticated, fraud attempts are increasing, digital systems are replacing human interaction. Understanding these changes is becoming an important part of protecting financial security. The sixth change is the labor market. Historically, retirement often meant stopping work entirely. Today, that picture is becoming more complicated. Some seniors choose to continue working because they enjoy it. Others continue because they need the income. Part-time work, consulting, seasonal work, and flexible employment are becoming more common among retirees. This is partly because people are healthier for longer, but it is also because retirement is becoming more expensive. For some households, a small amount of additional income can significantly improve financial flexibility. The seventh change is the growing pressure on pension systems. Many developed countries are facing demographic challenges. People are living longer, birth rates are lower, and there are fewer workers supporting a growing number of retirees. This creates financial pressure on public pension systems. It does not mean pensions will disappear, but it does mean governments may eventually make adjustments. Retirement ages may increase, benefits may change, taxes may rise. The details will vary from country to country, but the underlying trend is similar across much of the developed world. This is one reason many economists describe aging populations as one of the biggest economic stories of the coming decades. Now let's talk about what these changes actually mean for ordinary people. Imagine two retirees. Both worked hard, both saved responsibly, both followed the advice they were given. Yet one enters retirement with a paid-off home, little debt, manageable healthcare expenses, and financial flexibility. The other enters retirement with housing costs, debt payments, rising medical expenses, and little margin for unexpected events. The difference between those two situations can completely change the retirement experience. This is why the economic environment matters so much. Retirement success is not only determined by how much money someone saved, it is also influenced by inflation, housing costs, healthcare expenses, market conditions, taxes, and government policies. Many of these factors are outside individual control. That reality can feel uncomfortable, but understanding it is important because awareness creates options. Ignoring change rarely improves outcomes. Now, it would be easy to make this story sound hopeless, but that would not be accurate, because economic change also creates opportunities. The first opportunity is preparation. People who understand these trends early have more time to adjust. They can evaluate expenses, review budgets, understand their risks, and make thoughtful decisions instead of emotional ones. The second opportunity is flexibility. Retirement no longer has to follow one specific model. Some people choose part-time work, others downsize their homes, some relocate, others simplify their lifestyles. There is no single retirement blueprint anymore, and that flexibility can be powerful. The third opportunity is knowledge. Financial literacy has never been more valuable. Understanding inflation, understanding debt, understanding healthcare costs, understanding scams, understanding how technology is changing financial services. These skills help retirees make better decisions in an increasingly complex world. The practical lessons are surprisingly simple. Pay attention to expenses, understand where your money goes, respect inflation, monitor healthcare costs, be cautious with debt, stay informed about technology, remain skeptical of anyone promising guaranteed returns or easy wealth, and perhaps most importantly, stay adaptable. Because adaptability may become one of the most valuable retirement skills of the 21st century. The world is changing. The economy is changing. Retirement is changing. That does not mean retirement is doomed. It does not mean financial security is impossible. But it does mean the assumptions that worked 20 or 30 years ago may not be enough for the decades ahead. The seniors who thrive in this environment will not necessarily be the wealthiest. They may simply be the most prepared, the most informed, the most adaptable, and the most willing to understand the reality of the world as it is, rather than the world as it used to be. Because the economic changes happening today are not distant events taking place somewhere else. They are affecting grocery stores, healthcare bills, housing costs, retirement accounts, family budgets, and everyday life. The future remains uncertain. It always will be. But uncertainty is not the same thing as helplessness. And understanding the changes shaping the economy may be one of the most important steps any senior can take toward protecting their financial future.